So for the first video today, I want to run through the differences between cash flow lending and balance sheet lending. And actually there's also another section which I would call hybrid lending, and I'll get to that in just a minute. So cash flow funding is usually used when you are either getting an overdraft and you don't have security as a business, or when you're buying a business and you say want to buy a business for $1 million and you only have $500,000 in cash or equity. How do you fund the rest of it? Well, there's a couple of banks that I use off the top of my head, usually ANZ and NAB, and they will fund unsecured business purchases to begin with at that sort of level, around 50% equity required. And cash flow funding is really financing against the future cash flows of the business, as opposed to having real property security or other types of security. So, as I mentioned, you would approach a bank on the basis of buying a business with limited security, or alternatively, you may need an overdraft for working capital purposes. And in that case, you may not be able to offer real property security, but you do have good profits and good cash flows coming in. Other types of unsecured funding or cash flow funding might be short-term business loans. So as a broker, you may arrange something like a short-term loan through someone like Prosper or On Deck or Get Capital. I mean, there's 25 providers out there or more that we use, and certainly you can find plenty to become accredited with, and that process is fairly easy. Those short-term loans do help people out to do things like buy discounted stock or expand their business, pay for deposits on equipment, that sort of thing. And it's totally against the cash flows. So from a position of having a look at when a business is able to apply for this, usually they need strong revenues and strong profits, because that's all the bank has to rely on in relation to getting their money back. And so they have to be fairly strong businesses in relation to NAB or ANZ or one of the major banks financing them. If it's in respect to a short-term business loan, what you'll find is that someone like Prosper, as I mentioned before, or Get Capital, will look at the monthly revenues. And typically they'll give that business a percentage of those revenues in a short-term business loan. So you might be turning over $100,000 a month, and they'll give you around $80,000 as a loan to be repaid over 12 months or 2 years. Now, in relation to balance sheet lending, it's a different type of lending, and probably you've come across, no doubt, something like asset financing, equipment, cars. That's a balance sheet item. That is, it's an asset that's listed on the balance sheet, and you can fund against those. There are a lot of lenders outside the majors who will do things like, let you draw down on equity in farming equipment or graders or other types of equipment, and use that for working capital or other purposes. And so the real difference is that you actually have an asset as security, or the bank does at least. So the other couple of types that I want to talk about are what I call hybrids, technically probably incorrect, but debtor finance is something that brokers can arrange fairly easily, and it's easy to understand. So a debtor finance is really money owed to the business is called debtors, and so the invoices they generate, let's say they're owed $500,000. Typically you can draw down up to 80% of that, and sometimes 90%, and the client can get access to that money within 24 hours. So usually, say a business would invoice someone for their product and not get paid for 30 days or 60 days, but with debtor finance, they can draw down on that invoice up to 80%, have the money in their account, and then when they collect those funds, then they pay back the loan, less any fees and charges that the debtor financier puts in place. There's a couple of different ways to fund using debtor finance. Longer term contracts put in place by people like ScotPac, Octet, Bibby, a few of those larger ones. They'll probably want a client to sign a 12-month contract, and what that means is that they fund all of the invoices, and the client can draw down as it's needed, but there's usually a minimum charge per month that they have to pay. There's some other ones like Apricity or the Invoice Market, Cashflow Money, Cashflow Finance Australia, where they'll let clients jump in and jump out, as I call it. So they don't have to be tied to a contract. They can draw down on individual invoices if they want to. And what that means is that They could say jump in for 3 months of the year when they have lower cash flow. They can draw down on their invoices and pull that money forward, but they may not need it for the other 9 months of the year. So whilst the interest rates are a bit more expensive than the usuals, like the banks and Scott Packs, etc., it does on a dollar cost basis sometimes make sense if they only need 300 grand once a year. Other types of funding, which I would call hybrid if you like, is trade finance or stock financing. So stock financing and trade financing, you have the opportunity to offer to your clients a finance facility where, let's say they are purchasing $100,000 worth of stock, and they have to import it from overseas and it takes 6 weeks to get here. They may only need 10% of the amount required in equity, and the financier will put in place a facility for $90,000 over, say, a couple of months. When the stock gets here and is delivered to the client and invoiced, then you use debtor finance to draw down on that invoice and pay out the trade finance. So there's plenty of companies out there that will do both, like Octet, OCTET. Look, even the majors will do it as well for fairly strong companies. But if you've got smaller businesses, they've only been around a few years, you're probably better off going to some of the non-banks and using that type of finance to push them through the working capital cycle. So they can start with buying a piece of stock or import stock and then switch it across to debtor finance. And it means instead of having to pay $100,000 worth of cash for their stock up front, they're only putting in, say, 10 to 20,000, bringing it across and then invoicing the client for, say, 150 grand with their margin on top, drawing down 120 at 80% and paying out their old trade finance. And then in 60 days when they collect their invoices, then they pay out the debtor finance. So it pushes them through the whole working capital cycle without the need for real property security. Okay, I hope that's helped in relation to some cash flow funding and balance sheet funding, and we'll see you in the next video.